Very warm welcome to StudyIQ. I am Prashant Mahavani. I hope you all are doing good, dear friends. Today we are going to talk about this merger of three companies that you can see on your screen. Now, announcement or declaration regarding this merger was done by Finance Minister during his budget speech. And today we are not just going to limit ourselves with this merger. I am going to start this discussion. I have in fact divided this lecture into three different parts. The first one is about types of companies, because you find here a thing called unlisted public company. So what this unlisted company is all about, for that we have to go through different types of company. Very briefly we'll go through it, we'll understand what different types of companies are out there, then we'll talk about this merger, we'll go through this expert's opinion about it, whether this is good or bad and why the government has decided to merge them, and etc, and in the end, I will talk or throw some light on disinvestment. By the end of this lecture, you will realize that this 2018-19, during this year, we are going to see many mergers. Not sure about mergers yet, but definitely disinvestment is going to take place. For that, it is important for us to know types of company, just in case if there is any merger, then how it works and things like that, or why it is necessary, and of course disinvestment in the end. So let's crack on, and before that I would like to tell you two things. The first one is that don't worry about notes. You would be able to download this whole lecture, this notes or this PDF from my Facebook page. You can get in touch with me as well. This is my Facebook page here. You can follow me, and one of the most important thing is that pen drive and tablet courses of StudyIQ.com are available. On your screen you can see the range of things that we cover, and to find out more about it, all you have to do is check out StudyIQ.com. Just in case if you have any queries, then you have chat support on our portal, and you have these numbers as well. Feel free and give us a call, and we would be more than happy to help you out. Right, now coming on to this merger thing, this three PSUs, the government's plan to merge the three unlisted, this is the thing that we are going to discuss today, this unlisted public sector general insurance companies. They are known as PSGICs. Anyways, this is not that important, but this one is definitely important. Now, merger basically means you merge them, right? 1, 2 and 3, you merge them and make them or convert them into one company, one big giant company, maybe giant, we don't know. We'll talk about it as we move ahead. So here are the three companies here: National Insurance, United India Insurance Company, and Oriental Insurance Company. Now let's go through different types of company to understand what this unlisted public sector company is all about. As per this Companies Act 1956, and the latest one is this 2013 one, you have basically three types of company. The first one is unlimited company, or it is better known as proprietary kind of company in our country. The main thing about this proprietary kind of company is that just in case if you make a huge amount of loss, say for example you have borrowed huge amount of money from a bank, and if you are making loss and now you are not able to pay back that money, then the bank has the right to take away that or seize that property, may it be your office or your shop or in whatever asset and whatever things are there. Right, it can take over that thing, it can auction them and recover its money. Apart from that, they can also, right, under this unlimited company, your liability is unlimited, so they can in fact auction your house as well. So this is, of course, there are good points and bad points. The good point is that you don't have to share your profit with anyone, and the bad point is that just in case if you make loss, then you will lose everything. Then you have this company limited by guarantee. So as per your share, if you are 30% partner, then you will pay 30% of whatever losses that have been made and things like that. But our focus here is, and of course I'm sure this thing is clear to you, limited here, right? Company limited by guarantee. So your guarantee is limited. You don't have to give away your house and other properties, your personal properties, right? So this is about this company limited by guarantee. And of course I'm talking in layman's language. I'm not being too technical here, because I do understand that many of you are not from commerce background. You might be from arts or science, and some of you from commerce background as well. You might have left this thing, your education or your academics might have got over. So this will refresh all these theories and how it works and things like that. So being very to the point and using as simple examples as possible, right? And this is something that is required for general studies, right? For your competitive exams, of course, apart from your optional subject, for your general studies papers, you need to have basic understanding. That is more than enough. You don't have to have PhD in all these things, right? So the third one is about this company limited by shares. In this one, you have two categories. One is private and one is public. Very easy to understand. Public basically means a company that belongs to, or the owner is, government. Now you have this basic differences here. If you want to go into detail, you can go in it, right? This is just a list that I have sticked here just to throw some more technical light on this thing, right? So let's move on with this one. Not that important. Now let's understand the key difference between this listed versus unlisted company. Very important thing here. Now, may it be listed company or unlisted company, the main objective at the end of the day is to maximize profit, to make as much as profit possible. This is the main, you can say, goal or target or objective of any company. Now the basic difference between this listed and unlisted company can be, differences can be based on this size of your company, may it be small or big, structure. When I say structure, I'm not talking about just this physical structure. Of course, that thing matters as well. But your management structure, whether you have top level, bottom level, and this middle level, or you may have a very flat setup, so it depends, right? Then you have this methods of raising capital. This is very important, and this is something that that creates, you can say, a big divide between this listed and unlisted company. Now, listed companies are basically those companies that are listed on stock exchange. Now, what you do in stock exchange, basically you can sell and purchase shares. Now, what share is all about? Say, for example, you have a business and the total worth of that business is 100 rupees, right? And if I buy a share of your business, say, for example, if I have paid 10% of this total business, then I am the owner of this 10%. So I have a share of 10% in your business. So when I purchase a share from the stock market, and when your company is listed on this stock exchange, people can freely purchase and trade, and they can invest and purchase and sell your shares as per their as far as they have money, and as far as they can afford it, they can do all these things. So you can have extra money in your pocket. When I say pocket, I mean to say your capital, right? You can raise capital by issuing shares. So this is the biggest benefit of listing your company on a stock market. The downside is that you have to follow rules and regulation, because what happens is that earlier on you were the only owner, but now I have invested 10% in your business. So of course 10% is not a small amount. I may ask you, and I have all the right that I can ask you to produce your profit and loss and balance sheet and other things. I will ask you, like, what's your plan about the future of this business and things like that, and you have to explain this thing to me, because when you need money, when you are running out of money, when you need capital, you are issuing your shares, and I am purchasing that thing and I am becoming a partner at the end of the day. Now, technical things could be different. As I told you, layman's language, this is how it works. So as I have a stake in your business, you have to design all these rules and regulation. Everyone will stick with these rules and regulations, and all the things that you do should be within these rules and regulations that are defined. So you have to prepare these financial statements, and many times it takes a huge amount of your energy and money as well, and you have to stick with these rules and regulations. And as you are listed on stock exchange, you have to follow the rules and regulation of stock exchange as well. So here you have this brings in more rigidity. Your flexibility is a little bit gone, or not a little bit, but nearly gone, right? Because when you have to also ensure that you are making profit and things like that. So you can understand these are the things. Now, unlisted company is a company that is not listed on a stock market. Very simple to understand. But if you go through the books and over the internet, then you will find that this unlisted companies on the internet and the books, mostly they talk about that they are held by this private organization, or it is a private company. That's not always right. Even the government can have an unlisted company, right? It's not necessary that all companies of the government are listed on stock exchange. This 3 companies here, right, the one that you can see on your screen, or the main topic of our discussion, these 3 companies are unlisted public sector companies. The owner is Government of India. You can have different types of unlisted companies as well. You can have basically 3 types. One is owned by your central government, the second is by maybe state government, and the third one is jointly by both center and state government. If they need money, they can borrow a loan, they can issue bonds, right? Because they are owned by, say for example, central or state government or government, if they need money, then government can pump in money as well if capital is required, just in case. The problem with this company is that you cannot, as you are not listed on this stock market, it becomes a bit difficult for you to raise finance. If you take a loan, then of course you know that you have to pay interest, so you have to make that much amount of profit so that you can keep your head out of or keep your neck out of water. So this will create additional pressures and things like that. But the good side is that in terms of capital, you have a disadvantage in terms of your operations and in terms of your decision making and rules and regulations. They are a bit flexible when you compare it with this listed company. So I hope this thing is clear, right? So far, whatever we have discussed, I hope all these things are clear to you. Now let's crack on to the second phase. And this second phase is about coming back to this merger. And here one more point that of course I told you about this thing, that because you don't have to stick with so many rules and regulations, so you have a sort of flexibility and less complicated things when it comes to preparing your financial statements and things like that, and better control over the business operation this unlisted companies have. So government can pay full attention, or the government will have full control over the operation of these unlisted public companies. And if it is a private company, then of course the private party will have full control. So these are the things, right? So now let's move on to this whole merger thing that is the main, you can say, the core of this discussion. Now back in 2017, mid 2017, right, the Government of India, mid January 2017, beg your pardon, Government of India decided, in fact the CCEA, that is the Cabinet Committee on Economic Affairs, of course it is the heart and mind of government when we talk about cabinet. So Cabinet Committee on Economic Affairs, it decided, or it approved, that 5 state-owned general insurance companies will be listed on the stock market. One of the reasons behind this decision is, of course, government wants to get rid of nearly 25% of its stake, right? And what happens, very simple. Say for example you own a company, and if you say for example the total worth is 100 rupees. Now if you decide that you want to bring down your stake in this, your stake at present is 100%, so if you want to bring this down to, say for example, 25%, right, so you will sell this 25 rupee worth of asset or shares. You will issue share, and the money that you get in is yours, and you will, from then on, you will have 75% is yours and 25% belongs to your shareholders. So this is the reason and why the government does all these things. We will talk about it in the disinvestment portion, but for now let's see what happened last year. General Insurance Corporation of India, when it was listed on the stock market, and when government basically issued shares, government got 9,804 crore rupees. With this New India Insurance, back in November 2017, government got 9,096 crore rupees. And you have these 3 companies here, right? Now we are in 2018, and recently Finance Minister talked about this thing, that he's going to merge, or the Government of India is going to merge all these 3 different insurance companies into one. And one of the main reasons behind this thing is that because the health of these 3 insurance companies at present, they are not doing that good. They are in fact in red. So the merger announcement was announced by Finance Minister or Government of India, And as this merger was declared, this process of listing, this decision of CCEA regarding listing these companies, of course this one and this one, both of these companies are listed, but these three companies at present, they are not listed because the process is stopped by the government. It is stopped basically now because the thing is, if you go through some technical side of insurance business, then you find that you have to stick with solvency margin. Now what this solvency margin is all about, very simple. You have to say, for example, just keep this thing in mind, you have to be somewhere above this 1.5, right? What you see here, 1.9 is healthy because you are above 1.5, but if you are 1.11 and if you are 1.15, then this is not a good solvency ratio. This is something that is going on with this Oriental India and United India. These two companies are below this solvency margin of 1.5, and why this 1.5 is decided, it is basically a sort of safety net. You have to follow these rules. What happens is, just in case if something goes wrong, then this 1.5 is reserved with your this IRDA will keep this, and just in case if it requires, then it can pay or compensate your customers with this money that you have parked, or you can say that is kept as a reserve with IRDA. So this is the reason why you have to maintain this, and once you are below it, so naturally what happens, why you are going down, why your solvency ratio is going down, because you are not making profit. The way things are going on in your company are not good, or they are not taking you in the path, or you are not heading towards a profitable or sustainable business. So this is the reason your things will, or these figures will fall down, and once your figures fall down, what happens is that your shareholders, right, they will feel panic. They will get panicked, and they will take away, or they will sell your shares. And once your shares, once there is a vibe of people were having a share in your business, and now they are selling, they are ready to sell this stake that they have in your business, this indicates that things are not going right, and then this will create a sort of, or it will infect other people as well, right? So this will create a sort of a cycle, or many times when you cross this tipping point, once you cross this tipping point, then your fall will be a sort of nosedive fall. You will come straight down. So Government of India, of course, one of the reason why it is listing these companies on the stock exchanges is because if it wants to take out some money, right? It won't, Government of India basically wants some cash, or you can say some money in its own hand, and now the government of course is going to, it's not going to spend for miscellaneous things, it is going to invest in some better things. But if your business is not doing good, if your solvency margin is not met, and if you are registering losses as well, so even if you list, your shares are going to fall down. So rather than making money, you will lose money. So it is better to basically, you can say, do some fixes here and there, tighten some nut bolts here and there, and then you list your company on stock exchange. So something similar has been done by Government of India. It has decided that let's merge all these three companies together and let's make a giant out of it. And as per this IRDA, that is Insurance Regulatory and Development Authority of India, right, this at present the biggest insurance, general insurance, we are talking about general insurance company in India is this New India Insurance Company. This is the biggest one, and if you see its gross direct premium, this is GDP. This is not that gross domestic product GDP that we are talking about, right? This is this GDP associated with this insurance. So pay attention to this thing. When I say GDP, I'm talking about this GDP, gross direct premium. So this gross direct premium of this just one company, this New India Insurance Company, is 21,598 crore as per this IRDA, and this is of financial year 2017. This means that 16.50% of GDP of general and health insurance business in our country belongs to this New India Insurance Company. But when you will merge these three companies, and when this giant will be launched, right? Together these three giants will, or together these three companies into one giant, they will conquer, or they will get fetch this 41,462 crore rupees of GDP, and collectively they will clock 32% of this GDP of this general insurance market. So nearly twice than what this biggest company at present we have in our country. So you can understand that this is definitely going to be a very big giant. And if we take expert opinions, one expert of National Insurance Company, this chairman cum managing director, as per this Mr. Kumar, he is saying that this merger, right, will make this giant even more stronger, and the valuation of this whole giant thing will go up. So the achievement or the target of government to make some money out of it will be achieved. Apart from that, if you add all these four companies together, when I say four, I am taking these three companies, or you can take this one giant and then you can take this New India Insurance. If we add all of them together, then 48%, or roughly speaking you can say 50% of this general insurance and health market in our country will be handled by this four companies, right? So you can understand, and at the end of the day the maximum share is of government. So you can say these four government companies are going to look after this this 48% of market, and in fact they do as well at present as far as 2017 financial year 2017 is concerned. And then they will have a super control, nearly they will have a control over a third of non-life insurance market, which is going to make them a very strong contender. And together, if you calculate the whole of this motor, health, industrial insurance industry, this whole industry clocks 1.5 lakh crore rupees per year. This is not a small amount at all, isn't it? 1.5 lakh crore a year. So this is a big market, and then you can have this giant dominating this big market. And as per this chairman of New India Insurance, this merger will lead to higher retention capacity. That means you will be able to retain your customers, right? They will not stop their accounts with your company and then they will go to some other companies. No, you would be able to retain them. So it is good for business, because what happens is, I'm not sure whether you are aware about this thing. Let me throw some light on this thing. You know, when you cancel your postpaid mobile connection, they try the level best that you don't leave the company. The reason is because it is cheaper to retain a customer than to get a new one. If you calculate your advertisement and other things and efforts and time and energy, then it is cheaper to retain your customer. So higher retention capacity is a good thing, and it also means that money will be flowing. You know, you have the calculation that this person is going to pay this much amount of premium if he or she is staying with us. So you have some assurity regarding inflow of money as well. The second thing is subsequent listing and raising of capital will make them stronger, because now you are a big giant, and once you are a giant, once merged, you will cross all this solvency ratio thingy, and you will have joint assets and other things. So when you list yourself, your shares are hopefully going to go up, and when they go up, the government will also make money out of it and things like that. It will reduce competitive intensity. Three companies, one owner. It's like three, you can say, siblings competing with each other. They belong to same family. At the end of the day, whatever money they make is going to be deposited in family's kitty. But then as well, they are competing with each other, and this is not a healthy competition, and this is not how it should work. So when they become one, this competitive intensity will go away. In fact, their competitive drive can work if we know how to utilize it. Then this can work, or this can become a boon for this new giant. The best practices of these three different companies can be merged together. It will lead to better pricing and better underwriting of profitability as well. And if we go through some other experts, and the reason why I have added this expert opinion here is because these people, they have worked here in this sector, and they know, they are expert in this thing. So there is no harm in keeping our eyes and ears open when some expert is talking to us, isn't it? So as per this expert Ajay Bodke, he is Chief Executive and Chief Portfolio Manager. He is saying that it is a very positive move. It will provide scale. Scale basically means that unnecessary, you can say, layers, you can get rid of them. You can make it more agile, or whatever this industry is requiring. You can do that things. Then you will have more heft, and it will strengthen the balance sheet of all these companies. And this is not the first time we are seeing something like this in our country. We have seen something similar, or this sort of mergers in oil and gas sector. We have seen this in banking sector as well. So this is something that is in continuation in this insurance sector. Then you have some other opinions of other, you can say, other experts as well. You have this MD and CEO of SBI General Insurance. As per Mr. Mahapatra, he's saying that this is what government, as I told you, right, that government has decided that to merge them and then list them, so you can get more money from the share, from the people who are going to purchase your shares, and then you can improve your this will improve your operational efficiencies, and you can have new pricing models. You can launch new, so to say, products or services. When I say product, I mean to say, of course, you are going to cover insurance, you are providing insurance, but that is termed as product, of course, though it is a sort of service. So anyways, so you can offer many different options to your customers, and at the end of the day, in long term, it is going to be it will be beneficial for this insurance sector as well as your customers. And one of the biggest achievement that can be, you can say, made out of it is you can encourage domestic as well as foreign investors. You can attract foreign investors, and when you get money, when you are getting capital from foreign investors, right, then there is nothing better than that, FDI, right? So this is the things, these are the things associated with it, and this is it, all about this expert opinion. And one more thing before I close this phase 2 of our discussion. The results will be visible in next one and a half or 2 years. So we have to wait for these positive outcomes. Of course, this is a big company, big merger that we are talking about. So it will take time, right? It will take time. So possible outcomes, right? National insurance solvency margin. This national insurance solvency margin was 1.26. Now it is 1.90. After previous year it was 1.26. Now it is 1.90. Then you have this post-merger 15%. This investment can fetch government at least 9,000 crore rupees, and equity analysts estimates. Altogether 60,000 crore rupees will be the value of this company. And the government of India, in this budget speech, Finance Minister announced that 2018-19 this investment target is 80,000 crore rupees. So you can understand a big chunk of this investment target will be fulfilled by this listing of this big giant on your stock exchange. Now the question is why, and what are the ways, or what is this investment and why you do this investment. This investment basically means that say for example, if you have cash in your bank, if you have money in your bank, so whenever you need that money, you can just go to an ATM and you can withdraw that money, isn't it? So this indicates that this means that the property that you have is in a liquid form. But imagine you have 1 crore rupees, but this 1 crore rupees that we are talking about is you have invested it in your market. So of course in your shop or immovable property. So yes, you are owner of this 1 crore property, but you cannot say that it is in liquid state, isn't it? So this is one of the main reason to increase liquidities, to get rid of this rigidity or this solidness when you have invested all your eggs in a sort of solid thing or in this types of assets. So you can't have that much liquidity. So when you sell it, you are getting money in, money is coming in, and this can be invested in different in different, you can say, baskets. So one of the main reason, or this is basically what disinvestment is all about, turning your solid item into liquid form. And here when I say item, I'm talking about money, of course. Now this disinvestment can be a partly or a full disinvestment. You can either sell everything and just take away cash or money, or you can sell, say for example, 25%, as Government of India is doing at present. Now the reason behind this disinvestment, one, it could be strategic move, business in which you think that government is not suitable, or you are not suitable, or if someone else can do it better than you, then you decide that you can give it over or hand it over to that person or that company and take away money and invest it in some other portfolio. The second is, it could be that at present you would be running out of money, you desperately need money for something else, so you decide that let's sell a bit of property. This is something that we have seen, isn't it? You might have seen this sort of things taking place with different people as well. They have to sell their property if they need something, and once they are able to achieve, or if they are able to, if they see that they can make profit out of it, by selling this profit, by selling this basically property, if they can make profit out of it, and by investing that money in something else, and if they can make profit out of it, then you find that people do this sort of decisions. They do take this sort of decisions, isn't it? Then you have this bad health of PSUs and government. What happens is that this is the reason why government has decided to get rid of or to disinvest, because with public sector units, you know it very well, government jobs, sadly, many organizations, many PSUs, right, you have this sab chalta hai kind of attitude working over that everything will work, right? Who cares about achieving targets? And the best example is BSNL. At one point of time, it was having the best network possible, right? Landlines all across the board in our country were provided by this BSNL. And you know, I'm not sure whether you have used this BSNL telephones at that point of time when they were newly introduced in our country. I was a very small child at that point of time, but I do remember that when I was in school, or say for example college, at that point of time, whenever the phone used to be dead, and when you complain, when you place your complaint, it will take ages, right? Maybe 2 days, 5 days, 10 days, many times months as well, for this BSNL people to fix your telephone or fix your line. And the reason why they were able to do this thing, because they were in a monopoly business. They were not having any sort of competition, so sab chalta hai kind of thing was going on. But as soon as we had these private companies, and particularly this mobile business, when mobiles were introduced and when they became cheaper for everyone, then we know the state of this landline phones, and we also know the state of this BSNL too. I'm not sure in different parts of country, but there are many pockets in our country where BSNL is literally not able to do anything at all. It cannot stand with this all private companies, because the way private companies work, right, they have to make profit at the end of the day. If you are not performing, then you will be sacked or fired. So you have this pressure of performing, and because private companies are there for making profit, right? So they will count each and every penny. If they find some opportunity out there, then they will rush to it and things like that. So this is the work culture of private company. And when you compare it with this PSUs, you know that even if you make losses, then you have government of India or your state government, it will pump some money into your business, and you are never going to lose your job as far as you are not caught, right? Means I'm not saying that everyone is corrupted, but the thing is that even if there is no penalty of not doing job, isn't it? You'll be scolded or transferred. This is a sad human resource policy that we have. Anyways, so these are some of the drawbacks of PSUs, and what happens is that government keeps on pumping money. So for government, it is not a profitable business. It is not getting enough returns as it should when it is investing in this PSU. So it is better to get rid of them. The other thing is that you have these problems with PSU. You have this bureaucracy, and you have this red tapeism. So decision making takes a long time. You have a huge structure. Files will pass through many different desks, and then finally you can take some decision. Lack of autonomy is also there. You cannot take decisions as you like. You have to consult with many people, and this will take time. And if we see the present scenario, we find that economic heft, 235 odd PSUs chip in 20% of GDP and 15% of stock market capitalization through 50 listed firms. Big employers, right? It is employing some 10 lakh people. States, they have some 1,000 PSUs, but the thing is that if we go through some SIC PSUs and if you go through NICL UII's recommendation, then we find that NICL UII says that we have to get rid of this 40 PSUs. We have to do some strategic sales of this 40 PSUs, and we have to completely close this 26 SIC PSUs, because we are just pumping money, right? Government money or public's money is just being pumped in this PSUs, and they are not making any profit. The other thing is that the NICL UII and the government is also thinking about this thing, that the main job of the government is to govern or work as a catalyst agent. So it can create rules and regulations that are beneficial or are in favor of creating a business environment. So this is the best thing that government can do. So let the government do, or let it look after administration and management of the country, or you can say this policy making thing, and let other things like running your coal plant, running your insurance business, in fact your schools, prisons and colleges as well. NICL UII is saying that let these private sectors look after them. Of course, some things, some items or some sectors, like say for example nuclear energy, you cannot allow private companies to do that because of safety issues and other national security reasons. These sort of things can be kept under government's belt, but other things in which government is not able to perform, like say for example Air India, you know, free tickets for mantris and their families and free tickets for bureaucrats and other things. So this sort of things, if you are exploiting these things in this way, then of course they are going to make loss, isn't it? And nobody cares about it. There was a time, now things are a bit different, but you have better people out there in the private world. They can do this business a bit better than you, so let them do it, and let the whole country say for example head towards a path of prosperity. You have some other reasons here as well. Most of them have been discussed by us, like you can say to reduce the financial burden on the government, to improve public finances, to introduce competition and market discipline. At the end of the day, if two companies are competing with each other, this consumer at the end of the day is going to benefit out of it. To fund growth, to encourage wider share of ownership, depoliticize non-essential services, and of course the money that you get, right, when you disinvest, you get money coming in, and this money can be used for social programs like health and education. And the benefit that you get out of this health and education, or dividend or return that you get, if you think about long term, then we find that it will in fact growth and development. These two things are such that if you want growth, right, you cannot have growth on its own. You have to develop as well. And when you develop, when you invest in health, education and skill development of the people of our country, when you build good infrastructure, it will promote growth. And when you are in a path of growth, you can invest this money for development, and in this way they can complement each other. So that's everything that we have to discuss regarding this thing. I hope things are clear, right? It got a bit lengthy to 5 minutes here and there, but anyways, things were important. I'm sure you will appreciate the discussion that we have taken place, that has taken place in fact between you and I, and that's everything that I have to share with all of you guys. It's Saturday, so time to go out. I hope you all have something to do, and make the most out of this weekend so that Monday you have full energy. I will see you all soon. Enjoy your studies, and don't forget to check out my Facebook page. Jai Hind.